Okay, for the agenda for this evening, we are going through to understand why the growth stocks are attractive. And as you know, the FAANG stocks are known to be growth stocks, and we'll try to determine what's the reason why the FAANG stocks are so attractive to a lot of investors. But having said so, FAANG stocks refers to the Facebook, the Amazon, the Apple, Netflix, and also Google. Of course, the parent of Google is actually Alphabet. Having said so, are they all good investments, or some of them are good investments while some of the others may not be so great investments? And we will then suggest to you an analysis framework that we use. And let's also take a look at the analysis results. Then we also want to take a look at the valuation and the opportunities that lie ahead of us. And finally, looking at all the analysis results and so on, we will determine what is the investment strategies that we can use for the FAANG stocks. So for those of you who don't know me too well, let me give a quick 1 or 2 minute introduction about myself. I actually spent 2 decades in the telco and technology industry, and I was doing sales, product, as well as marketing. And I've been trained in value investing, and I've been doing options trading as well, with active investing experience for over 15 years. Right now, I kind of achieve financial flexibility, so I'm kind of 50% of the time doing active investment, while at the same time, I'm still managing some of the businesses that I have kind of passively. So I'm the founder of Journey with Money blog. You can actually go to journeywithmoney.com, and there are a number of articles related to investment that you can read. And I'm also at the same time the founder of Calm Investing. Currently, I'm managing a portfolio that I've set aside of $1 million. So this is how I derive most of my passive income today. I have the rental income, I have the plantations business income, and I also have 2 businesses that I'm kind of running passively. One is in digital marketing, of course, the other one is in agriculture. So along the way, while I was having passive income as well as active income, I actually asked myself if there is some way that I can actually put aside capital to derive some form of passive income from the stock market as well. So of course, when it comes to stock investment, one of the first things that I really feel that is actually quite important to us is set a goal in terms of our investment. I'm actually quite serious about the whole investment business. And I actually asked myself also, is 10% possible without taking too much risk? So I'll actually show you some of the examples that I do. And frankly speaking, I think it's possible to address your risks, manage your risks, as well as to try to achieve consistently more than 10% every year. And that way, depending, of course, the capital that you set aside, you will have a source of another income coming in. And it doesn't have to be spending a lot of time. In fact, I don't really spend a lot of time trading per se, but of course, I do spend a fair bit of time in so far as doing my homework, and in so far as doing research is concerned, looking into what are the stocks that I can actually invest in. So we do have additional participants who are coming in, so we'll just welcome them as they come in. At the same time, if you have any questions as we go through some of these slides, you can type into the chat, but I may or may not be able to respond to you. But at least I know that you are kind of listening in and absorbing some of the materials that I'm sharing with you. And if you have some questions, and if I'm not able to address right away, we will address at the end of this sharing session, which is probably going to take about an hour or so. Okay, so this is actually my life today. Of course, I miss all the traveling right now, and hopefully soon I will be able to go back to some of the traveling again. A lot of my time is also having a lot of sessions, sharing with people what we know, what we understand about investment in the stock market. And that is also a passion that I myself enjoy. And that's the reason why we come up with a lot of content creation around this whole topic of stock investment, and also sharing with people what are some of the opportunities that we can be looking at uh, during the ups and downs of the stock market. So actually yesterday, you saw that the US stock market was down by about 5 to 6%, and that dragged down the whole Asian market. I actually look at it, and yesterday I actually went a little bit into the market, picking up some of the stocks which are becoming uh, a bit undervalued or fairly valued, and then also in Singapore, I also began to go in and pick up one or two stocks. So just sharing with every one of you that there are different types of businesses. And of course, this evening we are talking about the FAANG stocks, which are the Facebook, the Amazon, the Apple, the Netflix, as well as the Google. But of course, you know that the parent of Google is actually Alphabet. And later on, you will appreciate what I'm talking about in terms of these different types of businesses. But basically, the types of businesses can be classified into these 6 categories. One is the fast growers, and these are the ones that are growing the businesses at 20% and more than 20% a year. Next is the stalwarts, which is the business is growing between 10% and 20%. And then the next one is the slow growers, which we say that they have the single digit growth. And typically what you will also find is that the stalwarts and the fast growers, they don't really pay out dividend to the shareholders. What they are doing is they are actually keeping whatever retained earnings and earnings that is coming into the company, and they are reinvesting back into the company, maybe in the form of new innovations, maybe in the form of R&D and so on, right? But the slow growers, they have single digit growth. In order to entice shareholders or rather investors to invest into the company, what they will have to do is they will probably have to give out some form of dividend. So these are the 3 interesting types of businesses that uh, we are mostly interested to invest in. The next is actually the cyclical. The cyclical will refer to the commodity players. It will refer to say the automobile industry, the airline industry, where they are subject to the business cycles of the business and the industry, and the earnings of the company go according to the cycles of the business. It's kind of up and down and so on, right? Some of the electronics industry, some of the semiconductor industry. And unless you know the company very well, or unless you know the industry very well, this type of business tends to be quite difficult to analyze and evaluate. The next one is turnarounds. They are not doing well, right? And maybe one day they will be able to turn around. They are not making a profit. They are making making a lot of losses. Um, but maybe one day they will turn around and become profitable again. And the last category is the asset play, where the way you do the valuation of the company is mostly based on the assets that they have. And these are usually the property plays or the banks, yeah, and so on, right? So when it comes to the FANG companies, later on we'll take a look at the growth, and let's try to classify them into which category they belong to. But I think they are mostly the fast growers or the stalwarts. So why growth stocks? Let's take a look at Apple, and I have put side by side the revenue growth of Apple as well as the earnings per share of Apple. So for those of you who are not too familiar, earnings per share is actually the total profit after tax, after interest, and divided by the number of outstanding shares the company has. So usually when we look at the price per share, we also relate it to the earnings per share, and that's how we derive at the PE ratio of a company. And I have put the revenue of Apple versus the earnings per share of Apple side by side from the year 2010 to the year 2019 for you to look at a comparison. Usually, I would like to look at companies and I like to see that when the earnings per share is growing in a certain trend, the revenue of the company is also growing in a certain trend. So between the revenue and earnings per share of Apple, we see that they are trending quite nicely, right? And the fact is that sometimes the revenue of a company is not really growing, but companies start to resort to some form of cost cutting, some form of cost management, and the earnings per share may still go up. Or sometimes what we also notice is that the company does some form of share buybacks. And even though the revenue is not growing very much, the earnings per share of the company may also grow faster than the revenue growth of the company. And it's quite important to find out how the earnings per share growth comes about to see whether there is any red flag that is related to the company or not. So for Apple, you can see that the 10-year revenue CAGR, which is a compounded annual growth rate, which means from 2010 all the way to 2019, it has been growing 16.6% every year. And the earnings per share CAGR is about 20.9%. There's a little bit of difference between the two growth rates, but I'm not too concerned about it because it's not a vast difference. And actually, if you are interested to find out why there's a difference, it is actually also because Apple has also done quite a fair bit of share buybacks over the last few years. And why we are interested in growth companies is because if you look at the share price of Apple, again, from the year about 2010 all the way to today, the share price of the company has also appreciated a lot. And in fact, if you go ahead and calculate, I think the share price has appreciated by about 30% CAGR. And what we know is that in the long term, share price goes with the trend of the earnings per share growth. Okay. And of course, although in the short term, sometimes the fluctuations of the share price is quite irrational, but in the long term, the share price tends to go with the trend of the earnings per share growth. And for investors who are looking for price appreciation, and that's the reason why you are looking for some of these companies with huge growth potential, all right? So I guess that's also the reason, as a result of this, that a lot of people are very interested in the FAANG stocks, and there's a lot of hype, if you will, to a certain extent about the FAANG stocks. Just for your information, usually we look at some of the market indexes in the US, and one of them is the NASDAQ, which is very heavily tech centric, and the other one is the S&P 500. The S&P 500 effectively refers to the top 500 listed companies in the States. And if you look at the S&P 500, although there are 500 major companies, if you go take a look at the breakdown, and this might be an interesting fact for you, in addition to some of the FAANG stocks, excluding Netflix, but including Microsoft. So it's the Facebook, it's the Amazon, it is the Apple, and it is the Google plus Microsoft. These five stocks actually constitute 20% of the S&P 500. Okay, so how the S&P 500 is fluctuating every day is very much influenced by five of the stocks in terms of the share price performance. If you go take a look at the NASDAQ, again, the composition is very heavily centered around, again, those four stocks plus Microsoft. I think it's about 45 to 50%. So while they are usually used as a benchmark of how the market is doing, just take note that they are very heavily revolve around the FAANG stocks plus Microsoft, of course excluding Netflix. So let's continue. I want to talk about the key investing principles, and of course, these are kind of extracted from famous investors like Warren Buffett, Charlie Munger, and so on. And if you look at the principles, actually, they are very simple. And if there's anything that you can get out from this evening session is to just remember some of these very basic investing principles. What they are saying is, buy wonderful stocks. Of course, it's just a statement. Later on, we'll take a look at what do you mean by wonderful companies, right? So buy wonderful companies, buy companies which you understand. I mean, another word for it is just circle of competence. You want to buy companies that is within your own area of expertise, your own education, whatever you do in your job, so that when you do research about them, you will be able to appreciate the company and the industry a lot better than other industries. Buy companies with durable competitive advantage. Another word for it that has been coined is economic moat. So when companies start to make money, a lot of the competitors will come in. So this sentence actually refers to the fact that, in order for companies to thrive in the long term and continue to be doing well, they must have some competitive advantage. They must have some differentiation in order to be able to still retain their customers, still continue to grow their businesses. Then the next one is also very common sense, right? Buy at a discount with a certain margin of safety. Once you kind of do your valuation and are able to determine what is a fair price, what is the intrinsic value to pay for a company, you want to buy it at a discount when the market is offering a discount to you. And lastly, buy companies with good management, right? So a good management team is also important to drive the direction, to lead the company in the right direction, to look at some of the trends, major trends in the industry, and to prepare the companies well accordingly. So the other point to take note of is having this mindset that whenever you buy a stock, you want to buy it as if you are buying a business. So I always like to think of it as this way, right? Currently, Facebook's market capitalization is probably about $600 billion. I mean, I don't have $600 billion, but I want to have this mindset that when I want to buy a certain share, a certain number of shares of Facebook, I want to assume that I have $600 billion to buy up the whole company. Of course, when I buy a certain percentage of the shares of the company, I'm becoming part owner of the company as well. But I want to have this mindset that, hey, I actually want to buy up the entire Facebook. And would I want to pay, I think it closed at about $220, $230 yesterday. So would I want to pay $220, $230 per share for Facebook if I want to own the entire company? And what kind of due diligence would I want to do in order to determine whether $220, $230 per share is a fair price to pay for the company? So we have this framework that we use in so far as the whole stock investment process is concerned. First of all, it's PhD, and I'll go through the PhD methodology later on and go in a little bit of elaboration. First of all is to find out what to buy and then do some valuation to say when to buy. Like I said earlier on, we want to buy it at a discount. And finally, it's also what is the strategy that we want to use in order to create profitability for ourselves. Whether is it going to be price appreciation, whether is it going to be drawing dividend from the investments that we have every now and then. So if you have any questions, just type it into the chat, and if I have the opportunity, I will address the questions, or if not, towards the end of the presentation, we will address whatever the questions that you may have together in this webinar. So this is a framework, but I won't go through too much of a detail. The earlier slide is actually a simplified framework that we use. Okay. So let me ask you, and if you can just help me type into the chat, right? How many of you actually know about the Netball World Cup, the INF Netball World Cup? How many of you actually watch it, follow it, and very enthusiastic fan of the INF Netball World Cup? Any of you? If you can just type it into the chat. Any of you? Not me. No, I don't follow. Okay. So anyway, this is of course for the women playing the netball and all that. But anyway, if you look at this kind of track record or the champions over the past few years, right? And let's just start with 1991. The champion was actually Australia. 1995 was Australia. 1999 was Australia again, and followed by New Zealand and Australia, Australia, Australia. 2019 was last year, and I actually know who is the champion. But if I were to ask you to make a guess, who is the champion in 2019? What will be your answer? What will be your guess? If, again, you can type into the chat and I'll just read out to everybody. And of course, all of you, I think, will be able to see the chat as well. What will be your guess? Who was the champion in 2019? Anybody? Australia? Kenneth say Australia. Andrew also say Australia. Any other answers? Not quite, huh? So actually the answer was New Zealand. But whether it's Australia or New Zealand is it's not the most important. But from here we can derive the higher probability of who is going to be the champion, right? So for stock investment, short of a way to say that, hey, how do we project into the future? Insofar as the performance of a company is concerned, we can always look back and take a look at the performance of the company for the past 10 years, for example. So what we want to do is to look at the track record of a company and then project into the future about the company. Of course, when we do the projection about the company's future performance, what we would like to do is to kind of understand about the company's products and services, the R&D, the innovations that is coming up. And if we know well about the company, we will then be able to kind of do a good projection insofar as the projected performance of the company is concerned into the future. So that's what we want to do as a methodology, right? Looking at the company's past performance and then projecting the company's performance into the future. And that's how we can do a bit of analysis with regards to the company's performance in the future. So going into the PhD fundamental analysis method, this is a framework or methodology that we use when we do the analysis of a company. And this part is still pretty much the evaluation of the company's performance in the past, right? But from here, we will then know that, hey, this company has done well and in these three aspects. And these three aspects to us, they are very important because the company is here to make a profit, right? So we want to see how profitable it is. A company's profitability, of course, it can either be driven by its own shareholders' equity, or it can be driven by borrowing money from the bank to invest further into the business. But by having a lot of liability, by having a lot of loans, there is the danger of whether the company is going to be able to pay the loans. So we want to also take a look at the financial health. The company should not be too leveraged in a sense, right? And of course, earlier on we talked about why a company grows its share price. It has to do with how it is driving its earnings per share over the years. And that's the reason why we want to take a look at the growth drivers, how the company is going to be able to continue to grow its revenue as well as earnings, retaining its uh, customers, making sure that the loyalty to the company's products and services is there. So that's the methodology that we are going to be using to analyze the FAANG stocks, sort of like a summary, but I will also go into a detailed analysis of one particular stock, one particular company. So very quickly, for the profitability dimensions, we are looking at a net margin greater than 15%. For the return on asset, we are looking at 7%. The return on equity more than 15%, and the free cash flow over revenue more than 5%. Uh, in the interest of time, I won't go into the detail of the explanation, but these are the financial metrics with regards to profitability that we want to use to evaluate the dimension of profitability with regards to the FAANG stocks. So I've kind of done a summary, and later on when we go into a little bit more detail, I will use Facebook as the case study to go into a lot more detail. So as a summary, if you look at Facebook, and it's okay for you to take down notes, I will just pause a little bit here, and let's take a hard look at the FAANG stocks. Why is it that everybody is interested and investing into the FAANG stocks? And in fact, if you look at the FAANG stocks this couple of weeks, when the market has rebounded from the time in March when there was a huge correction of 30%, it has since rebounded, and some of them are even doing better than before the correction, right? And I think looking at this summary table, you will be able to see that in fact a lot of these companies fare very, very well in so far as the PhD or the profitability dimension is concerned. So we look at Facebook, free cash flow, pass, and so on. Amazon net margin dimension is actually a fail. But again, of course, the general dimensions of all these criteria should apply to most of the companies across the board. But for Amazon, their profit margin tends to be lesser because they are talking about volume. So for this dimension, it's the fail, but it doesn't mean that, Amazon as a result, we should not be investing into it. I think there are a few other factors that we should be investigating, and perhaps later we can take a look at it. Then Apple is also a pass in all the dimensions. Google, again, is a solid pass in all the other dimensions. Netflix is one of those that I don't really invest in. The rest of the other FAANG stocks I have invested directly or indirectly, but Netflix is one of them that I don't really invest in or have not invested in. And I guess one of the reasons is because of this, that if you look at the free cash flow, it's actually a fail, and net margin is actually a fail. So I'm a little bit concerned about this, although the revenue growth is fairly tremendous. The other one is the financial health that we want to take a look. And of course, Peter Lynch famously said that companies that have no debt can't go bankrupt. So there are a few metrics that we are interested in. The first one is debt to equity. We are looking for a ratio less than 0.5 times interest earned. How well the company is able to pay for all the interest expenses, and we are looking for a multiple greater than 10. Current ratio, we are looking for a ratio greater than 1.5. So again, a summary of all the FAANG stocks. Let's take a look at it. Facebook is a solid pass in all of them. Let's go to Google first. It's a pass for all of them. Let's take a look at Apple. Fail in debt to equity, but there's a reason to this, and actually they didn't really fail this dimension very badly. And as some of you may know, Apple actually has a net cash of about $100 billion. So I'm not too concerned about this. They also have a lot of cash outside of the US, and that's because of some tax implications that they have not really, moved a lot of all this cash back to the States as well. So I'm not too concerned about that. And pass for interest coverage, pass for current ratio. For Amazon, it's a fail for the debt to equity because they are probably still doing quite a fair bit of investment. Pass for interest coverage, current ratio, not the most critical. Netflix is a fail, fail, fail for all the three dimensions. So again, that really gives me the discomfort if I were to go ahead to invest in this company. Okay, so growth drivers, let's take a look at growth drivers. And earlier on, I've already shared with you about Apple, right? So the revenue growth as well as the earnings per share growth. But more importantly, let's investigate also the sources of growth, right? So let's use Apple as an example. One way to grow the revenue as well as the earnings per share is to sell more goods or services. So as some of you may know, Apple has grown the iPhone sales tremendously, but over the last 1 or 2 years, the iPhone sales has also stagnated a little bit, right? So sometimes you see 1 or 2% growth, sometimes you don't see any growth at all. Apple's revenue contribution from China is 20%. That's why China is a very big market, a very important market to them. So one of the things that a lot of the analysts are looking at is really the iPhone sales performance insofar as this company is concerned. And 60% of their revenue contribution still comes from iPhone alone, although they have so many other products and services. The other way to grow the company is, of course, to raise prices. So for those of you who use a lot of iPhone and iPad and so on, you will have this frustration that they keep raising their product prices. But for this to continue, it can only be up to a certain stage, right? If it becomes too expensive, then the consumers may want to start looking for alternatives as well. And another way to grow the company is to sell new goods or services. So, for example, Apple Watch, for example, AirPods, and these two new product lines actually happen to be doing fairly well. Another way is, of course, buying another company or merger or acquisition, but this is not really the best strategy, so to speak. And for Apple, they have not really done any major acquisition. They have bought some smaller companies more because of the technology that they are able to bring into the company. So let's go back to the growth drivers and taking a look at the earnings per share growth of the various FAANG companies. If you look at Facebook, there was a slight dip, but later on when we go into the detailed analysis of the company, we'll take a look at it in further detail. Amazon, for a very long time, it's really quite flat. But you can see that the last few years it has been tremendous growth. And I wouldn't be surprised if you put the share price of Amazon side by side. You will also see a similar pattern that the share price has appreciated greatly over the last few years from the year around about 2017 all the way to now. Apple has been a bit more consistent. You can see that it's very steady growth from 2010 to 2019. So very steady, right? And for Google, it's also a nice pattern of very nice growth. For Netflix, whether the company is going to be whether the company is going to be tremendous in terms of value or not, uh, I think it has yet to be seen as far as this company is concerned. And I have shown you about the profitability. I've shown you about the debt level. Uh, I mean, some people who are into growth stocks and they have higher risk appetite, they may still consider this company. But to me, in terms of the risk reward, I would still prefer like the Facebook, like the Apple, like the Google, even Amazon. Um, to a certain extent, it's harder to make an assessment of whether it is a good investment or not. But for Netflix, it's really one of those among the five FAANG stocks that I have a little bit of trouble trying to invest into the company because of the risk reward ratio. Okay, so we have looked at the what to buy, right? And looking at the FAANG stocks, at least from my own assessment, I'm fairly comfortable with Facebook. I'm fairly comfortable with Apple. I'm fairly comfortable with Google. Uh, Amazon, to a certain extent, I'm quite okay, but if I want to go ahead and invest to Amazon, I think it must give me a good price. The price must be a lot more attractive. Then I will probably go in and invest into the company. Netflix is one of the five that I'm probably going to take a look and then monitor the company's performance before I take the plunge to investing into the company. So that's how I go through the whole thought process, and that's how I go through the analysis process in terms of the FANG stocks and what to buy, which one to buy. The next one is when to buy, and this has got to do with valuation, right? The share price of the market goes up and down. As I say, long term is going to reflect the earnings per share growth of the company, but short term, it fluctuates. And Mr. Market may not be rational most of the time. And when it's not rational, sometimes the price is too high, sometimes the price is too low. When the price they offer you is low, that is when the time you have the opportunity and you can buy great companies at a discount and at a good discount, right? So the next step is to try to do some valuation, right? And I'm going to just switch over the screen share to the spreadsheet where I analyze Facebook, okay? And you will then appreciate a little bit more about the whole evaluation process. So just give me a thumbs up to let me know that you are seeing on your screen the spreadsheet now and not the slides. Okay, right. So the other sections I've actually gone through earlier on. And if you look at Facebook, and let's just go back and revisit the free cash flow over revenue, the profitability dimensions. I just want to point out to you that if you look at the free cash flow over revenue, and free cash flow actually reflects for every dollar that the company is earning, right, how much cash is generating. And as you know, actually free cash flow is very important to the company. For a company like Facebook, even though it's a technology company, it's still generating so much of free cash flow as a percentage of revenue. It actually means that they are very, very efficient in terms of generating cash. It's really a cash generation machine if you look at it. But if you look at the later few years, if you look at the free cash flow, it has come down. If you look at the net margin, it has come down. And this all has got to do with the fact that they have some security issues, they have some data leak issues, and they are employing a lot of people right now to kind of manually make sure that all these security concerns and all that is addressed. And they actually had to pay a lot of fines for all the data breach and all that kind of stuff. But I'm actually quite confident that this is a short-term thing, and in a longer term, a technology company like them would be able to utilize technology, artificial intelligence to automate a lot of all this, right? But in any case, if you look at what we are doing here, insofar as the valuation is concerned, what we want to do is to take a look at the earnings per share and then look at the performance in the past. So last 10 years, the growth is about 50%. 5 years is 49. The recent 3 years is reduced to 9% because of the reasons I mentioned. But I'm actually quite confident that this will pick up fairly soon. And there are also some interesting developments around the company. The fact that they are going into a lot more e-commerce initiatives, the fact that they are also looking at launching sort of like a Bitcoin equivalent, which they call the Libra, which has also attracted some indication of interest from the market, if I remember correctly, right? So I'm going to assume that the next 10-year growth of the company is about 20% and another 10 years after that. So we are looking at moving forward 20 years, right? The first 10 years being 20% and then the next 10 year about 6%. And if we use the discounted cash flow valuation method, and if I use a discount rate of 10.5%, the valuation of the company is going to be about $221. Okay. And if I want to build in some margin of safety or what we call a discount, then I'm going to be quite comfortable buying the company Facebook at about $180. So, in March, Facebook actually dropped all the way to about $150. And that's the time when I went in to buy. I didn't buy a lot this time, but I did make a good profit. And I used some of the other strategies to invest into Facebook during that time when the price was around about $150. In March, it actually dropped to about $150. Okay. So this is how I actually do the whole valuation technique. And this is how I decide that, this is a great company. This is a wonderful company. And if I know the value, if I know the price, this is about the price range that I'm going to be investing in the company. So really, if I tag a price tag to the company, even if let's say I don't give a certain margin of safety, I would be kind of comfortable to buy the company at about $180 to about $220 without a discount. Preferably, I can get it at $180 or lower. But if I want to start investing, I will probably start investing in the company at about $220. Okay, so this is how I will do the valuation of the company. So let me go back to the slide. So I'm just going to switch over the screen. Okay, so I'm back to the slides. Again, if you have any questions, just type it into the chat and then we'll address the questions. If not, at the end of the whole session, we can address your questions together. So that's how I derive Facebook at about $180 to $220. Okay. Yesterday, the share price of Facebook closed at $224. So it's still a little bit higher than what I would want to go in at. Right. Today, I think the market is going to open higher. So there may not be an opportunity to go in. But let's do the other strategies. There may be some other strategies that we can use to try to go into Facebook if we want to at this moment. Amazon, it's more difficult to do the valuation, but if I want to give it a range, I would say 1,700 to about 2,500 per share, right? Yesterday it closed at 2,558. So again, still slightly higher than what we will want to buy it. Look at Apple. I will give the valuation between $230 to $270. Yesterday it closed at $336. It's one of those that I would consider very overvalued at this moment. And I'm a little bit concerned, right? And I don't know about you, but if I'm holding Apple share right now, the downside is just a lot more than the upside given the kind of valuation that is commanding today. And I think the next quarterly earnings result will be quite key to really understand how Apple is doing given the current pandemic environment and very difficult environment that we are facing. Netflix, totally way out. I just don't know how to invest into this company right now. Google, it's interesting. It's one of those that I invested in. I took profit, but I'm closely watching. Again, a solid company, a very differentiated company, a wonderful company that I would like to accumulate the shares for a long time. Um, and I'm just waiting. And actually, in March, if I'm not wrong, it actually dropped to about 1,000. I just didn't know why I could miss this, that I didn't accumulate more. Or rather, actually, I, I, I actually bought some, but I took profit, but I didn't really accumulate a lot during that time. So this is one of those that I don't want to miss the opportunity again. So right now, if you ask me, I'm really looking very closely at Facebook. I'm really looking very closely at Google. Um, as far as Amazon and Apple is concerned, because I'm invested into Berkshire Hathaway, which is the company that is run by Warren Buffett. And Warren Buffett, Berkshire Hathaway has got shares in Apple as well as Amazon. So I will just write on them, right? If Apple continues to do well, Amazon continues to do well, to a certain extent, Berkshire Hathaway will benefit from the price appreciation of these two as well. But if the price of these two really comes down quite a fair bit, then I will also be interested to pick up some. So let's take a look at the market and see where we are right now, right? When we do investment into individual stocks, we also want to benchmark against the market, because if the market is too expensive and if the market moves, even individual stocks, while they are undervalued, they will also move accordingly as compared to the market, right? So one important thing to do is also to look at the market and use it as a benchmark to determine when is a good time for you to go into individual stocks as well. Even though, of course, the most important thing is to look at the intrinsic value vis-a-vis the share price. And whenever you feel comfortable that you are buying up great stocks with a discount, with a good margin of safety, you should go ahead and buy, right? But of course, you should probably buy in batches, do a strategy which we call dollar cost averaging, which we'll talk about a bit more later. But if you look at one valuation of whether the whole market as a whole is expensive or not, one way to look at it is the Buffett indicator, which is just the total market capitalization over the GDP, right? And anything that is that is between 90% and 115% will be considered overvalued, right? And anything that is a ratio of more than 115% will be significantly overvalued. And where are we today? In fact, I extracted this chart just about two to 3 days ago, and it's around about 150%. So we are significantly overvalued insofar as the market is concerned, right? So this is the Buffett indicator. Let's take a look at another indicator, which is what we call the Shiller PE, price earnings ratio. Another term for it is the seasonally adjusted PE ratio. And again, if you take a look at it, where we are today is about 29.92. And again, on a median level, it's probably around about 20, right? P ratio of about 20. So again, it's kind of fairly expensive insofar as the whole market is concerned, right? Now, I want to share this chart with you, and this chart actually has mentally prepared me to always try to invest into companies that is always going to grow its value. And how a company grows its value over time is to grow its revenue as well as earnings per share over time, right? And what it reflects is that if the company is always growing at reasonable growth rate, the value and thus what we discussed earlier on, the share price in the long term is always going to go up, right? And if you are looking for price appreciation as an investor, we should only be buying into wonderful companies like this. So the other thing that I want to show you is that if you look at this red circle over here, what it tries to portray is that even though I do my valuation, even though I make some educated assumptions about the future growth of the company, say if I make some mistake, right, and I bought it slightly overvalued compared to what I should have bought it, right? So if the share price is below the value of the company, those are points where I should be buying the shares when it is overvalued. But if let's say I make some mistake and I bought it over value, right? You can see that if this is a good growth company, the share price will always go up, right? And if I continue to be a long-term investor and I hold on to the stock, it's going to be okay for me. I'm still going to be I'm still going to be profiting from this particular investment, right? So this has guided my investment philosophy a lot. So just to emphasize a little bit more, I guess if you are a value investor, then the investor mindset is always investing for the long term. I mean, there's another way to make money from the stock market, and that is a bit of day trading, a bit of short-term trading, but the methodology, the whole investment philosophy is going to be different. There's the cut loss strategy and so on and so forth. There's the technical analysis, looking at signals and so on. But if you want it to be, to me, I think it's a simpler form of investment, and you can sleep well. You do your research, you do your homework, you accumulate your knowledge about a particular company over time, and then you do dollar cost averaging, you slowly accumulate the shares of a good company. I think you can sleep well, and you don't have to track and monitor the prices of the company too often. Every quarter when they announce their earnings, when they talk about future directions, future developments, just follow and then to understand a bit more about the company. So we have talked about the PhD, what to buy. We have talked about the valuation technique, when to buy. I I'm now going into the third part, which is the strategy, how to create the cash flow, how to profit from the investments that we are undertaking. Okay, so I propose to you three strategies here. One is of course dollar cost averaging, and just take a look at my dollar cost averaging strategy for one of the companies that I hold, which is American Express. Okay, and I won't go into discussing why I chose American Express and not Visa and not Mastercard. But at the point in time when I bought American Express at 121, on the 26th of Feb, I thought it's a good price. But of course, we all know what started to happen, right? Around about March. So it dropped and I started to buy more, right? Of course, you have to have a lot of conviction that, hey, you are not making a major mistake. Uh, and in which case, if you are making a major mistake, then you want to really cut loss and forget about this particular investment altogether. But I was actually quite convinced that yeah, American Express for the longer term is still a good investment. So I started to dollar cost average, and then I bought, and then it started to recover a little bit. So my average cost is about 105. Of course, these few days is hovering around 105. I was already into profit, but again, this is a longer term investment. Yesterday, it actually dropped below 105, but I'm not too concerned about it. Yeah, I think today it's going back up to 105 again. So the other strategy that I have is, of course, have a comfortable margin of safety and hold long term. So earlier on, I talked about discount. I talked about Facebook. I'm comfortable with a price range of between $180 to $220. So a way to manage it is to say that, hey, if it is a company that you are very comfortable, that you are very confident, then the margin of safety doesn't need to be so high. But if it is a company that you are still building up your knowledge about, you want to know a bit more, so maybe a company like a Netflix, then I will want to command a higher margin of safety, right? And finally is the option strategy. And I will explain a bit more about option strategy. But maybe I can just take the opportunity to ask you if you are familiar with options, stock options. Are you familiar with stock options? Maybe can I just get an understanding as to how many of you understand options and how many of you I will have to explain a bit more about options and then how I use the strategy to invest into the market as well. Okay, so Kenneth say just recently in our boot camp. Any other response? Okay, so it's okay. I'll just go explain a bit about options and how we use it to use it as a strategy in our investment strategy as well. Okay, so you can see that all these companies are actually insurance companies, right? And to a large extent, what do insurance companies do? They actually provide a protection to consumers, right? So if, say, for example, I own a car, I will want to buy a car insurance from one of the insurance companies. And by doing so, what the insurance company is doing is they are providing a protection for the asset that I'm holding. And in this particular instance, the asset that I'm holding is actually the car. So if anything happens, they will do some protection against the damages that the car may incur, right? But by doing so, as a buyer of the insurance, I actually need to pay a certain money, right, to the insurance company. We call that the insurance premium, right? So this sort of like protection mechanism is also available in the stock market, and we call it the sell put strategy. We call it the sell put option. Okay, so let me use a Facebook example. Facebook current price is about $230. Assuming that I am prepared to buy Facebook at $220 per share, I can either wait, right? I can wait for the share price to drop to $220. But I can also use option strategy to try to make some cash flow, right? So what that means is that there is a mechanism for me to sell a put option, okay, which is a contract that I guarantee to the buyer that if Facebook's price drops to $220 and below, I will buy the shares from him, right? As to why he or she wants to, sell the shares at $220 is probably because he or she thinks that, hey, maybe Facebook share price will continue to go up, but they want to lock in the profit at $220. So I've already done my valuation and I'm happy to buy Facebook at $220. I can either wait for share price to drop to $220, then I just buy, or I can actually offer a protection. I can sell a put option to the market, to people who want to buy a protection. and I just guarantee that I will pick up the shares from him or her, right, at $220, but they have to pay me a premium. Okay, so this is kind of the summary, but let's just focus on the put, right? And if I sell a put option, I'm promising to buy the stock at a certain agreed price, and the buyer will actually pay me a certain premium, right? So this is an example of what I do. I have done some sell put option. Some of these symbols will be a little bit of Greek to you at this moment if you are not too familiar, but never mind, right? But basically what I have done is I have done all my calculations and say, for example, Alibaba at that point in time, I actually want to buy Alibaba shares at $170, but the share price during that time may be about $180, $190. So instead of waiting for Alibaba price to wait, and of course, if the Alibaba price drops to $170 and if I have extra cash, I will still go ahead and buy. But instead of waiting, I actually performed this transaction and I actually collected $355. Okay, so there are a number of transactions as a sample here that I have done, and my capital that I have set aside in case I have to buy up the shares is about $60,000, and as a whole, I actually collected 2% return for the month. So this is per month, right? For the month. So if I continue to do this on a monthly basis, right, the return that I'm actually really looking at is 2 times 12, which is 24%, right? So this is one of the options that I use to a large extent to actually make sure that my return from the stock investment as a whole is actually quite good, right? So earlier on, I started the whole presentation by saying that I'm looking at anything that is more than 10% per annum every year. But frankly speaking, if I combine the buy and hold strategy, buy wonderful companies, and then the option strategy, sometimes my return is actually fairly good. Like every year, I can be looking at 20 over percent. So that's the sell put option strategy that I also deploy after determining what is the share price, what is the fair value of the company that I want to buy. I will use this strategy while waiting for the share price to drop to that particular price, right? So I don't even need to wait. I can already generate cash flow as I wait for the prices to drop. So this is my last slide, and then we'll open for some discussions. I will open for some Q&A, right? But as a quick summary, some FAANG stocks are really better than others. So it doesn't mean that everybody is chasing the FAANG stocks. We should do the same. I think we should do the analysis to see what kind of company would fit into our portfolio well, right? And what company in terms of risk reward you may not want to do so, or it should only be a smaller percentage of the entire portfolio, right? Um, I also think the growth prospects of these FAANG companies remain great, and fortunately or unfortunately, with the pandemic and with people changing their lifestyle, working from home, we just see a tremendous explosion of uh, digitization and adoption of all these digital technologies, and I think it's just going to help them grow even further, right? Um, and I do see that all the FANG stocks uh, would benefit from this whole digital adoption, you know, kind of a forced digital adoption by everybody. And, I think we also look at the fact that, investment is actually not too difficult, right? As a fundamental principle, we should buy only wonderful companies and buy at a discount. And I've shared with you strategies like dollar cost averaging, using options, right? and finally also have a long-term investment mindset. So I happen to have read this book, which is The Four, right? It doesn't include Netflix, but it includes Amazon, Apple, Facebook, and Google. And it's a very good book in a sense that they talk about the strengths and why this company have become so strong. And if you have the time and if you have already decided to invest in any of these companies, I think it's a good book to pick up to understand a bit more. There are also sections whereby they talk about, hey, how do you discover companies which may potentially become similar to the four, right? So it did talk about Tesla. It did talk about company like Alibaba, which is a company that I really like, that I have done the investigation, the analysis, and I invested into Alibaba. And in the longer term, it is also one of those that I want to build. So there's also a little bit of diversification if I invest into Alibaba, because all these are US based and Alibaba is based in uh, China, right? And it's addressing a different market. So that comes to the end of the presentation. And what I want to do now is, of course, if you have questions, if you are not shy, you can just unmute yourself and ask the questions accordingly. Or, if you want to just type into the chat, you can type into the chat as well. So any questions?